Hamilton here with the Trading Initiative, and I want to drop a quick video on what we expect to happen not only this upcoming week, but potentially for the next few weeks in a row, maybe the rest of Q1 going into Q2 of 2023. It's currently February 5th. It's Sunday, prepping for the Sunday night strat session inside of TTI, and I just want to go through some of the index moves. There's so many bears still screaming all over social media, FinTwit, Stock Talk, on the news, etc., screaming that a recession is coming. Eggs are expensive. You know, you have anonymous cartoon characters on FinTwit screaming that everyone that's buying this rally is an idiot. I just want to say, first and foremost, if these guys had any ounce of credibility left after shorting this recent pop-up over the last 8 weeks, you know, they would just stop tweeting. They would just simply, you want to continue to short this rally, feel free, but to sit there and scream at people for making money after buying this rally early on is just beyond me. So what I want to do is I want to take a step back really quick and show you exactly how we were able to, in the middle to end of December, start buying these growth names and why we were able to make money during this most previous rally. Before we start, please, if you like this type of content, like, subscribe, follow, comment below, do everything you need to do to get this video out to more people. We're slowly growing this channel. Finally, they're up and over 430 subscribers. Thank you so much for everybody that does watch these videos and finds value. I would love it if this, channel continued to grow. I do like making these videos, but as always, it's a lot more fun to make these videos when people are actually watching them. So once again, I appreciate each of you for taking the time to watch this, and let's get into it. First things first, I just want to look at indexes from a purely technical standpoint. Take a step back. I don't care what's going on in, other parts of the world. I don't care what's going on the news. I don't care what's going on in your life. You shouldn't care what's going on in my life. Our biases don't mean anything. The only thing that matters in terms of trading as a technical trader is price, right? So first off, just bluntly, I'm a very, cut and dry type of trader. Take whatever you think is going to happen and just remove the thought process, and let's strictly look at price. We understand what a downtrend is, right? It's a series of lower highs and lower lows. This is a patented downtrend. We have a series of lower highs and lower lows. What happened in October/November? The markets, from a absolute standpoint, came down and hit their lows, high volume bounce, and here we are starting to begin an uptrend, right? So a series of higher highs, series of higher lows, and we placed on the major index SPY a new higher high on a quarterly basis. If you go back, this is October, next high is in December, next low is in beginning of January, next high is in February. This is now a quarterly higher high. This is not just, a run-of-the-mill rally bounce, dead cat bounce, bear rally, whatever you want to call it. This is a patented uptrend on a quarterly basis on the largest index that matters to us, the S&P 500 SPY, right? So this matters. For bears to sit here and scream that this is just a bear market rally makes no sense. As a matter of fact, from a purely definition standpoint, a bull market starts off of a 20% move off of the lows, and we are nearly there in the S&P 500 on SPY. So what happens if we do get to 20%? Are we allowed to actually call it a bull market? Are bears going to self-destruct if that happens? I don't know. But from a purely technical standpoint, I'm going to go ahead and remove some of these brush strokes here. From a purely technical standpoint, we are in an uptrend on a quarterly basis. We're trading above the 200-day moving average. RSI is confirming this bullish momentum. There's no divergence. There's nothing. This appears to be a solid uptrend on a macro, type of timeline here. I do expect some short-term pullbacks as the market is running a little hot. I wouldn't be surprised if we came down and retested this previous level here where we hit our previous higher high. Come down and test this, consolidate, maybe a little dip below really quick before another oscillation to the upside into a higher high. I fully expect SPY to continue up, and I do think that we will find some relative resistance here at 430. This is kind of what we're planning for inside of TTI. We want to continue to remain long, specifically, areas of the market that are showing strength, and as long as SPY is moving in the right direction, there's no reason for us to try to close our positions early and or even open up some shorts. We don't want to do that. Why do we want to short strength? It doesn't make any sense to us. So I would expect some consolidation or some resistance here at 430, but for all intents and purposes, SPY is in an uptrend. If you're able to grab this early, you are loving this rally. If you were not able to grab this early, you are hating this rally. And if you have been bearish this entire rally, well, good luck. I hope you still have some cash in your account. Let's move over to the Qs really quick. Same sort of story here. We have now officially hit higher highs on a quarterly basis. An absolute trend here is forming. Higher highs, higher lows. We should find some Once again, some resistance here up near 330, 333, something like that. Previous oscillations high generally are going to introduce some short-term resistance here. So I would expect the Qs to come up and test the 330 area, find some consolidation, potentially oscillate back down a little bit before another higher high. But still, from a quarterly basis, this is a higher high. I expect the Qs, just like the S&P 500, to continue up and to the right. The trend right now is up. And remember, for a bull market to start, the indexes need to be up over 20%, which at one point they technically were, but we closed on Friday at 306. So we are up about 17-18% off of those most recent lows. Very close to a technical bull market on the NASDAQ there. IWM, the last index here I want to go over is your small caps, right? And this is realistically what led us to actually be going long in December. We'll go over that in 1 second here. But IWM, one more time, it's just very easy to see. Higher highs, higher lows, and we're the first index right here actually testing that previous oscillation high in late August up here near $200. So this is going to be a big psychological and technical level here to get over. You see that there's a lot of volume there through the VRVP and IWM. I do expect it to be an argument. There's going to be a fight there. So potentially some consolidation, maybe a minor pullback before ultimately a breakthrough, right? So all three indexes are lining up. Higher highs on a quarterly basis, the beginnings of an uptrend, and all of them are flirting with a potential bull market. If we go back, well, I shouldn't probably use that. We use the most recent low here. We are also very close to a bull market here at 15-16%. So all three indexes shaping up, trading north of their 200-day moving averages, breaking out across previous resistance areas into quarterly highs, and nearly all of them are up 20% off of their lows. This is not a bear market, guys. This is not a bear market. And just to prove one more point here, Intel, a trade that I took and I made a video on. You can go ahead and watch that if you have time. It's the most previous video, right? The latest video that I made. But realistically, I just want to point out Intel bombed earnings. Huge gap down. What happened? Over the next 5 sessions, it got right back up. This is not bear market mentality. This is not what happens in a bear market. Companies do not capitulate off of terrible ER just to get bought right back up over a few sessions in a bear market. This is bull market mentality. This is bull market liquidity. So really quick, I want to show you guys something. Using Koyfin, this is like our favorite macro analysis tool. You can use the free version. I use the paid version because it gives you a lot of sweet tools. But what I want you to focus on is how we came up with this thesis of actually being able to buy back in December and the beginning of January. If you've been consuming any of the content on the YouTube, TikTok, or specifically Twitter, you know that we have been long growth names since the beginning of January, and for the more riskier guys since the end of December. How are we able to do that? Well, a lot of it comes down to understanding the difference between value and growth. If you can visualize this, right? This is a 3-month chart here. We're seeing growth versus value. In the beginning of January, we started to see the beginnings of a convergence between growth and value, right? And in a quote-unquote bull market, the markets tend to move better when growth is in control. You can always hit higher highs with value leading. We've seen it in the mid-2000s after the dot-com bubble burst. You know, we saw it last year, actually, as energy was hitting higher highs into a bunch of names hitting all-time highs, Exxon, Chevron, etc. The market was still grinding to the upside, but it just is not easy trading. When growth is in the lead, the market just tends to feel better, trade easier, etc. We saw that start to converge in the first 2 weeks of January. And we took mental note of it. As a matter of fact, if you can see right here, going back to the January 16th through January 20th weekly charts here on the Circle app, this is where we put all of the information for guys that can't join us during the strategy sessions. You know, you're busy, you have work, you can't make everything. We try to make it as easy as possible for the guys inside the group that just don't have a lot of time. We noted this relationship, this convergence of value versus growth. We knew that value had been performing better than growth for an entire year plus. And we said, listen, something is going on here. As you can see in the summary, although it's early to say for sure, value is beginning to converge with growth, and we saw considerable strength in small cap growth stocks. This could be the beginning of a relationship change where growth begins to outperform value. Lo and behold, that was the right call. So when we took this thesis, we built this thesis based off of this direct relationship change, we took positions off of that as well, and that is part of the reason why we were able to grab them so early. You saw a few other charts there. I want to go ahead and capitalize on some of these things. IWO has been an absolute game changer when you understand what small cap growth means for the overall market sentiment. There's only one reason why you're buying the most risky assets of the market. right? The most risky assets of the market are bought not during bull markets, or excuse me, not during bear markets. They are bought during bull market or bull market tendencies, right? You are not going to go and buy the stuff that can capitulate 90% if you're afraid that the market itself is going to capitulate, another 20, 30%. You're just not going to go and put your capital at risk there. So logically, when does it make sense to go out and put capital, your precious, account capital, when does it make sense to go and allocate that to the most riskiest parts of the market? When you expect the market to reward that type of risky behavior. That is not bear market mentality. That is bull market. We noticed at the beginning of January that was where money was flowing. As you can see, IWO against SPY. This is a normalized performance against the S&P 500. So we're looking at the relationship change between small cap growth and the major market index. And we said, listen, small cap growth is being bought disproportionately to the major market index and some of the largest companies in the world. That is bull market territory. We should be looking and potentially entering in with some of these small cap growths. If you look at IWM, we're looking through it. That thing was the first to break to the upside. There's a reason why small caps lead both up and down, because there's potentially the greatest rewards in those companies. And so when the market begins to shift and you see money flow into those small cap areas, specifically growth, you have to pay attention because you can grab some incredible entries. Not only IWO though, IVW, growth in general, started to outperform. This is a direct relationship change from all of last year where value was outperforming everything, specifically IVE. If we go back one full year, you can see probably IVE is going to be up there, absolutely up 12.26% year over year. This is your large cap value in terms of healthcare. Healthcare was near all-time highs just a few weeks ago. Energy near all-time highs right now. Some financial names, even with financials beat down, certain areas of the financial sector were up. Insurance, for example, hitting all-time highs. This was leading the market, right? Value or growth, on the other hand, was not. Large cap growth in particular was underperforming and getting killed, right? So you can think of Apple, Tesla, Amazon, Facebook, Google, all of these names just got absolutely destroyed last year. But what started to happen at the beginning of this year? We started to see some strength start to rotate back in, right? Large cap growth, still underperforming, by the way. If we go year to date, you can see still underperforming, by the way. But we're starting to see the sentiment shift. And we started that first with this small cap growth. That's why a lot of the positions that you see on our channel, on our Twitter feed, etc., directly reflect this small cap growth mentality. We're in a lot of these different big blue sky setups, MBLY, AEHR, ALGM. A lot of these are up huge, like 50, 60, 70, 80% since we were first able to grab them end of December, beginning of January, directly because of this relationship. Really quick, because we're running the gambit in CoinFin, let's go ahead and look at the 3-month chart on U.S. sector performance communications. Absolutely the worst going back year over year. As you can see, we're still down 22.77% against the S&P, not against the S&P, excuse me, just 22.77% year over year and underperforming the S&P 500 SPY, right? If we go to the 3-month, which is where we've kind of been dealing with our data coming into Q1 of 2023, XLC, though, has outperformed the most. So we generally aren't in the business of buying the weakest names, but when we start to see the flow come in, we start to see sentiment shift and the big underperformers start to perform. As you can see at the beginning of 2023, you want to recognize that and try to take a position as early as possible. Think names like Meta, think names like your social names, Pinterest, Etsy. These names are up right now, right? And as a matter of fact, they're up the most over the last 3 months. Tech as well. Huge underperformer in 2022 is now up second, just eclipsing the materials and real estate market. So growth in general, making significant strides here through the first month of Q1 2023 in consumer discretionary as well. This is why a majority of our money that is currently in positions, this is why we're attacking the growth area of the market. We were able to identify this at the beginning of 2023, this relationship change. We're not pumping money into healthcare. We're not pumping money into energy, at least with any huge amount of size, because right now the market is rewarding growth. Last area I want to look at, just industries, in particular, semiconductors. Semiconductors right now, if you've been watching any of our content, we are long names like ALGM, which is a huge win. We're up 700% right now on our contracts. TSM, NVIDIA, I believe ON Semiconductors at an all-time high. That's our exposure right now across the board in semiconductors. Everybody has their own thing within the group. But look, I mean, you can see from the beginning of 2023, this was where in the market started to shift. Growth started to take control, and you see money flow into semiconductors. We went and bought them. We bought them for a reason. because we understand that when sentiment shifts and we can start to see where money's flowing on a sector and industry basis, it makes our job as swing traders 100 times easier. Just go find the strongest stocks inside this industry. You already know it's beating everything else, so go find it. All right? So hopefully this helps you guys when it comes to formulating a thesis, where you want to be in the market for the next, quarter or 2 quarters. Are the indexes going to continue on up? We say, yeah, probably. It's going to take a lot for the markets to start to change this trend that has been in place since October potentially. Not necessarily the easiest trading at the end of last year, but it set us up for a very profitable Q1 so far in 2023. And we don't expect it to stop anytime soon, right? So go back and look at SPY and give you my pitch here. Listen, guys, if you work full-time, 9 to 5, you are a corporate guy, or you just value your family time and you don't have time to day trade, that's what we specialize in. TTI is all about swing trading, utilizing our TTI trading system. We help guys with 9 to 5s learn how to navigate the market profitably, and it's all we do. We do not focus day trading whatsoever. We run 3 strat sessions a week. We analyze over 1,000 charts a week. We come up with trade ideas as a group. We take them as a group, and like I just showed you on our platform, if you can't make it, we post everything inside of the circle stuff, so you can come whenever you need and review everything that you were doing. You know exactly what we're trading, why we're trading it, and how we're trading it every single time. All right, guys, so if you appreciate this, please like, subscribe, comment below, and I'll catch you next video.